Imagine a world where everyone thinks they're in on the secret. The kind of club so exclusive, you don't get to apply, you're chosen. The whispers pass quietly over steakhouse dinners in Manhattan, at golf courses in Palm Beach, in the smoke-filled private rooms of country clubs. I know a guy, he never. And that guy was Bernie Madoff. Here's the kicker. This wasn't some shadowy figure lurking in the financial underground. No, Madoff was practically Wall Street royalty. He was the founder of a legitimate trading firm, a pioneer in electronic trading, even the chairman of NASDAQ at one point. A man whose resume sparkled so brightly, it blinded people to the fact that his investment strategy was basically a cardboard set propped up on a Hollywood backlot. But let's rewind. Born in Queens in 1938, Bernie Lawrence Madoff didn't exactly scream future financial supervillain. He started small, literally, with $5,000 earned from lifeguarding and installing sprinklers. In 1960, he founded Bernard L. Madoff Investment Securities. Back then, the stock market wasn't the sleek digital world we know today. It was ticker tape, shouting traders, and lots of paper. Madoff's early innovation was spotting how computers could streamline all that chaos. He positioned himself as forward-thinking, the nerd who could out-hustle the old boys club. And it worked. Over the next few decades, Madoff became a pillar of Wall Street. His firm was one of the biggest players in market making, ensuring trades actually happened when buyers and sellers met. Regulators loved him, fellow traders admired him. He donated millions to charities, including hospitals, universities, and Jewish organizations. To the outside world, Bernie wasn't just successful, he was trustworthy, the kind of man you'd leave your kids with, or more importantly, your life savings. And here's where the story tilts. Somewhere along the way, Bernie discovered something magical. People didn't really want complicated brilliance. They wanted certainty. They wanted the investing equivalent of comfort food, safe, consistent returns. None of this stocks go up, stocks go down roller coaster nonsense. What Madoff promised was simple: steady growth, 10 to 12% like clockwork, year after year. Rain or shine, dot-com bubble, or financial crisis, Bernie delivered. Of course, you and I know the stock market doesn't work that way. If anyone tells you they've cracked the code and can produce smooth returns forever, you should either run away or start checking for hidden cameras. But Madoff's genius was in making the unbelievable look boringly believable. His supposed strategy? Split strike conversion. Sounds technical, right? He described it as a mix of buying stocks and hedging with options to balance risk. In reality, he was doing the financial equivalent of saying, I'll have one from column A and one from column B, without ever showing the menu. But people didn't question it. Why? Because Bernie was Bernie. Because their friends were already invested. Because exclusivity was part of the allure. In fact, half the time you couldn't even get in, unless you knew someone, unless you were wealthy enough, unless you were in the right social circle. That, sorry, no room for you, routine only made people more desperate to get their money in. It was less hedge fund, more velvet rope nightclub. And the money flowed in. By the 1990s, Bernie's reputation as the quiet genius who never missed was cemented. Banks, hedge funds, pension funds, they all handed him billions. Charities entrusted him with their endowments. He had feeder funds, essentially middlemen who raised money from investors and funneled it to Madoff, taking a cut for themselves. These were often big-name firms in Europe and America managing billions. Now, let's pause here, because you might be wondering, was everyone asleep? Weren't there warning signs? Oh, absolutely. Financial analyst Harry Markopolos famously raised the alarm as early as 2000, presenting regulators with a report literally titled, "The World's Largest Hedge Fund is a Fraud." He showed how Madoff's returns didn't match mathematical reality. But the SEC, the supposed watchdog, shrugged. After all, this was Bernie. The man shook hands with regulators, served on advisory committees, even helped write the rules. He was like the teacher's pet caught smoking in the bathroom. Nah, not him. He's one of the good ones. Meanwhile, investors kept throwing money at him. By the mid-2000s, Madoff was handling tens of billions of dollars. On paper, his clients' accounts showed a combined balance of about $65 billion. The crazy part? There were no actual trades behind it. The statements investors received, filled with lines of stocks supposedly bought and sold at perfect prices, were just made up, literally printed out on an old IBM computer from the 1980s in a dingy office on the 17th floor. Picture the absurdity. Upstairs, on the 19th floor, Madoff's legitimate market-making business hummed with screens, phones, and analysts. Downstairs, in what employees later called the fraud floor, a handful of staffers were forging account statements, cutting and pasting numbers like an arts and crafts project. This wasn't high-tech wizardry. It was financial forgery with the side of toner ink. And yet, no one noticed. Because who would question the man hosting charity galas? The guy who seemed almost boring in his predictability. He wasn't flamboyant like other Wall Street sharks. No Ferraris, no gold chains, no Twitter rants. He preferred yachts in Montauk, understated suits, and an image of respectability. If anything, his normal exterior was the perfect camouflage. The system worked for decades. As long as new money kept flowing in, Bernie could pay out withdrawals to existing investors. Classic Ponzi scheme mechanics. And because most clients were content with seeing steady numbers on their statements, they rarely cashed out in full. Why kill the golden goose? But like every good heist movie, you can feel the tension building. The cracks invisible at first, then widening. By 2007, whispers of the financial crisis were spreading. In 2008, when Lehman Brothers collapsed and the global economy went into freefall, investors panicked. Suddenly, everyone wanted their money back. Madoff's fortress of illusion, built over nearly half a century, was about to crumble under the weight of reality. And that's where we leave Bernie, for now, sitting in his luxurious Manhattan office, staring at requests for billions in redemptions he couldn't possibly meet. The clock was ticking, and the greatest lie in Wall Street history was about to be exposed.
December 2008. The world is already reeling from the financial crisis. Jobs vanishing, stock portfolios gutted, headlines screaming collapse. Against that backdrop, Bernie Madoff gathers his two sons, Mark and Andrew, in his penthouse apartment on the Upper East Side. The mood isn't celebratory. No champagne, no smug grin. Instead, Bernie leans in and admits, it's all one big lie. Imagine that moment. The man his sons had idolized, worked alongside, trusted for decades, confessing he hadn't just bent the rules, he'd incinerated them. This wasn't a little fudging, a couple of bad trades swept under the rug. It was the largest Ponzi scheme in history, a $65 billion mirage. His sons, stunned, didn't hug him or shield him. They called their lawyer. Hours later, Bernie Madoff was in FBI custody. When agents asked, "What's your story?" Madoff, ever the master of understatement, replied, "There is no innocent explanation." The dominoes began falling fast. The once respected titan of Wall Street became the face of deceit. Investors, from billionaires to retirees, scrambled to understand what just happened to their life saving. For some, it was catastrophic. Families discovered that their nest eggs, carefully set aside for decades, had evaporated. Charities closed their doors overnight because their endowments, millions entrusted to Bernie, were gone. Hospitals canceled research. Universities scrambled to replace lost funding. And then came the personal tragedies. Perhaps the most haunting was the story of René Thierry Magon de la Villouche, a French financier whose fund had funneled $1.4 billion into Madoff's scheme. Just days after the arrest, he locked himself in his New York office and took his own life. Others followed in the months and years ahead, ruined not just financially, but emotionally, unable to reconcile the betrayal. Madoff himself became a symbol of greed and gullibility. Reporters camped outside his apartment. Angry investors shouted in the streets. The press nicknamed him the monster of Wall Street. And yet, in interviews, Bernie seemed disturbingly calm, almost detached. He admitted the fraud began in the early 1990s, though some investigators believe it may have started as far back as the 1970s. He portrayed himself as trapped, like he'd fallen into the scheme and couldn't escape. But that doesn't quite fit the picture of a man running two separate offices, one legitimate, one churning out fake statements like a counterfeit factory. The mechanics were absurdly simple. No trades, no investments, just a bank account at Chase Manhattan. Money in, money out. New deposits paid off old withdrawals. That's it. No genius, no algorithm, no magic formula. Yet this simple scam reached such an unimaginable scale because trust is the most valuable currency on Wall Street. And Bernie had it in spades. When the case went to court in 2009, Madoff shocked even his own lawyers by pleading guilty. No trial, no long defense. He admitted to 11 federal felonies, including securities fraud, wire fraud, money laundering, and perjury. The judge sentenced him to the maximum, 150 years in prison. As the handcuffs clicked shut, you could almost hear the collective sigh of disbelief. How had it gone on this long? But the fallout wasn't just about one man. It exposed gaping holes in regulation. The SEC, which had ignored Harry Markopoulos's warnings for nearly a decade, took massive public heat. Congressional hearings grilled officials. How could the watchdogs miss something so blatant? It wasn't hidden in offshore accounts or disguised by exotic derivatives. It was right there in Manhattan, run by a man they regularly shook hands with. Recovery efforts began almost immediately. Trustee Irving Picard was tasked with clawing back money for victims. That meant suing feeder funds and wealthy clients who'd withdrawn more than they put in, because in a Ponzi scheme, some people inevitably walk away richer, while others are left holding the bag. Over the years, Picard recovered over $14 billion, a record sum for such a case. Still, that's less than a quarter of what investors believed they had. Meanwhile, the Madoff family imploded. His wife, Ruth, who once enjoyed a life of mansions, yachts, and Hampton soirees, was left with just $2.5 million after forfeiting nearly everything else. His sons, who claimed ignorance of the fraud, were hounded by lawsuits and public suspicion. René Madoff tragically died by suicide on the second anniversary of his father's arrest. Andrew died of cancer a few years later. The family name became radioactive. As for Bernie, prison became his final stage. He lived out his days in a federal facility in North Carolina, reportedly offering investment advice to fellow inmates. In April 2021, he died at age 82. No lavish funeral, no public memorial, just the quiet end of a man who had once commanded billions. But the story doesn't really end there, because the legacy of Madoff isn't just about stolen money. It's about broken trust. His scheme didn't merely empty bank accounts. It eroded confidence in the very system that millions rely on for retirement, for education, for the future. It forced regulators to rethink oversight. It made investors more skeptical. And it remains a case study in how human psychology, greed, fear, the lure of exclusivity can blind even the smartest people. Here's the irony. Bernie Madoff didn't invent anything new. Ponzi schemes date back at least a century, named after Charles Ponzi, who conned thousands in the 1920s. But Madoff perfected the art of scale. He took the oldest trick in the con man's playbook and dressed it up in Armani suits, NASDAQ credentials, and charity dinners, and the world bought it. There's a line that echoes through every financial scandal. If it sounds too good to be true, it probably is. Yet when it came to Bernie, people ignored it. Maybe because the returns weren't outrageous, 10 to 12%, not 100. Maybe because exclusivity is intoxicating. Maybe because deep down, we all want to believe in the myth of the financial wizard who sees what others can't. In the end, the $65 billion lie was less about one man and more about all of us, the regulators who looked away, the investors who suspended disbelief, the culture that worships wealth and whispers, if he's rich, he must be smart. So what's Berhen's legacy? A wrecked empire, ruined lives, reforms written in the ashes of betrayal, but also a cautionary tale we can't afford to forget, because somewhere, right now, another smooth-talking genius in a nice suit is promising steady returns, and someone else is nodding along, checkbook in hand. And if history teaches us anything, it's this: the con never really dies. It just changes its name, hires a new PR team, and waits for the next believer.